How about now? Yep, perfect. Okay, great. So what we're going to cover today is briefly is the acronym cheat sheet that I call. You guys all have access to this within the information that we provided to you guys, and we'll kind of go through it really quickly. If I am going quick, please stop me. If there's certain important points that I have, let me know. So we're going to start off with affiliated business arrangement disclosure, AFBA. Who here wants to take a stab and tell me what this has to do with?
I'll give it a stab.
Yeah.
So I guess the lender needs to disclose to the borrower if they are working with any like title agents or uh, I don't know, attorneys or other third party
Close.
vendors.
If what though? So let's break down the root, right? So when we think of affiliated, like you have some type of what with affiliation, like when you're doing something.
Connection.
Hey, we all love doing,
Perhaps you own the
real
business,
estate.
like a
Um,
connection.
but you do it for the purposes of compensation, right?
Mhm.
Affiliated business arrangement. So the affiliate business arrangement disclosure is generally signed if, let's say, you are any professional, but the most common one is usually an attorney who has a vested interest in a title company. So anytime you have a vested interest of more than 1%, which is basically the lowest potential vested interest you could basically have, right? 1%, the consumer must be made aware of that, and they have to sign an affiliated business arrangement disclosure, basically saying that they're cool with you getting paid, performing one aspect of the transaction, and having a vested interest in another. Make sense? Now, us as originators, we are not allowed to be compensated multiple times. We'll even dive in more into the SAFE Act. You guys should have went over with your instructor before, specifically in terms of um, how you guys get paid too, right? So like Anna, I'm gonna give you a 7% interest rate, and Simone, because you're cool, I'm gonna give you a 5% interest rate. Same rate, I mean, same credit, same home type, same all parameters. I just like Simone because she's cool and she's nice, and Anna's me. Doesn't work that way. Um, it's there's no vested interest specifically within the mortgage industry from direct lenders perspective as to you getting a higher or lower rate from compensation and so on and so forth. Okay, that has been completely eliminated because of predatory lending, right? The reality of it is that sure you're looking for the best interest of the client, but hey, if I can make an extra 3, 4, $5,000, you're generally going to, whether you're putting them in an FHA loan, conventional loan, 7%, 5%, 2%. Make sense? American Land Title Association, this is also known as the ALTA. This is basically what the sellers end up signing that breaks all the costs of the transaction. Okay. What is their net proceeds, right? So normally if you're an investor or just selling your house, you have to sign an ALTA, which basically breaks down what was the purchase price. If you have a mortgage, it goes what's your payoff. The bottom number would be your net proceed minus realtor commissions, minus sewer, minus you got a lien on the property or anything like that. The ALTA breaks everything down for that. Okay. APR is your annual percentage rate. You guys should have went over different than your interest rate. The APR is generally always higher than the interest rate because it's the total cost finance, including discount points, closing costs, spread over the life of the 360 years if you're getting a 30-year mortgage or less 180 and so on and so forth. ARM, adjustable rate mortgages. This has made a big turn back, I guess you could say, right? Over the last 12 months, 18 months, right? As rates kind of to slowly start turning a little bit higher when the Fed announced they were tapering, rates started to turn higher and everybody was like, holy crap, a 5 or 6% interest rate is really high when it really isn't in reality. But then consumers were looking at adjustable rate mortgages because what is when you get your first rate, what is that rate called?
Interest rates?
Yes, but there's a word, there's a word before that, right? So when you get an ARM mortgage, what's the first rate called? Begins with a T.
Teaser.
They're good, right? When you go on a date, whatever, I'll try to keep this quick as possible. You tease someone, right? Same exact thing, right? So it's a teaser rate. You don't get the full amortized rate, you get the teaser rate. And then on top of that, you guys remember to keep an eye on margins, index, and ceilings, right? So that's when we think of ARM mortgages. Like I said, ARM mortgages has slowly been making some buzz over the last couple of months because fixed rate mortgages had kind of taken a little bit higher rate. Okay. And please stop me if you guys have any questions as I kind of go through these really quickly. If you got a jam-packed day, let me know. CD, also known as closing disclosure. So who here remembers how many days does the CD, prelim CD, has to be signed and executed before you can close?
3 days.
3 days. 3.
And the closing disclosure, right, used to be called the HUD-1 settlement sheet. It was changed to closing disclosure. It essentially mirrors the loan estimate in terms of visuals and aesthetics, right? It looks literally the exact same way. It just, instead of the top, instead of it saying loan estimate, it says closing disclosure. And usually about the prelim 3 days before closing, I always tell my clients is about like 90 to 95% accurate of what your final numbers are. And the reason why it's not 100% accurate is because the title company or likely the settlement agent are still finalizing the seller's side, and the buyer's side of the bank. They're matching their invoices. They're putting everything together if they haven't already, right? And then just remember, guys, when there was certain restrictions that the bank has in terms of what's called cumulative tolerances, right? You guys remember that? Things that you can control, which is generally the banking side, right? So if an attorney wants to disclose that they're going to charge $1,000 and then change it to 3,000, it's a little steep, but they're not subjected under that. Things that the clients can shop for, like a title company, perfectly fine. But if it comes to an appraisal, credit report, bank origination, bank commitment, things that we kind of should know, we want to make sure that it's being quoted correctly, or else the bank has to cover it through what's called a cure. Okay. CFPB, these are the big guys. I always call them the sheriffs in town. So the CFPB, Consumer Financial Protection Bureau, they are the ones that make sure that everybody is following majority of these rules. They are predominantly the people that are enforcing these rules and regulations. Previous to the CFPB being adopted, there was, I want to say, 10 to 15 different agencies, kind of small subcategory agencies, and then they all more or less got what's the word? Merged or put together to create the CFPB. Okay. The CHARM is a consumer handbook on adjustable rate mortgages.
I remember that.
The handbook. So when a client is getting an ARM mortgage, the client must confirm they've received the copy of this handbook that educates them on what are the pros and cons of receiving an adjustable rate mortgage. Make sense? CLTV is your combined loan to value. So we all know what loan to value is, right? How much is a house worth or the sale price, lesser of the two, compared to what you're financing? That's your loan to value. Now, CLTV comes into play if you have a second mortgage, like a HELOC, or you've taken out a line of credit. You add those two, first loan amount, second loan amount, over the value of the home, and that's your CLTV. That's your combined loan to value. 1 + 1, combining. Cost of funds index, we kind of went over that. That comes into play specifically when your rate is adjustable. CRV, certificate of reasonable value, again comes into play with an appraisal, right? We're going to get the certificate of reasonable value, like I had just showed you guys. I had that appraisal come in, circulate a copy to all parties, letting them know that the value came in. DU, desktop underwriting. This is an automated underwriting system, also sometimes referred to as AUS. Now, Desktop underwriting is specific for which secondary market agency? Who here remembers?
Fannie.
Very good. And what's the 4 letters that Fannie Mae also gets referred to by?
FNMA.
MA.
Right? It's really not that complicated, but I really would love for you guys to break it down like that. Sometimes we'll freeze and we'll be like, oh shit, I didn't study that. But then you're like, well, Fannie Mae. So FNMA, right? I would love for you guys to kind of remember it that way. Of course, don't memorize it like like parrot, but understand that it's broken down like that. Just too much information. It's important for you guys to understand a lot of material as it's being promoted to us. So SDU, ECOA is a big one. So ECOA, also known as Regulation B, like to remember it as B equal, right? And that's also referred to as the Equal Credit Opportunity Act. Okay, so you want to make sure that when you're a professional, this doesn't just fall generally over mortgages; it's throughout the industry. That you're being fair to everybody, race, gender, ethnicity, age, also, and receipt of public assistance, right? So if a consumer is receiving some type of public assistance, child support, alimony, or anything like that, us as originators, we are not allowed to discriminate, right, against a consumer receiving that type of income, right? FACTA, Fair and Accurate Credit Transactions Act. So whenever we think of FACTA, I want you guys to remember identity theft. Okay, so identity theft, anything that more or less kind of revolves around FACTA, generally covers the provisions of identity theft. So there's that. And then I want you guys to also remember what are some of the rules, such as like red flags. You guys remember that? Where institutions need to make sure that they don't leave, you ever walk into a bank or a financial institution, you ever see like paperwork on their desk? I would hope not, right? But it's usually clear. There's no papers lying around. All the papers is like either in
A file cabinet.
storage locker, yeah, where it's locked and secured. If you have papers that you have to throw out, you can't put it in the trash. They have to be put in like a either shredded or in a shredder box, right? We have it in my office. And that's really mainly under obviously identity theft, but also factors. Fair Credit Reporting Act, Regulation V. This one is super important. Fair Credit Reporting Act, you're going to hear it a lot. FCRA, which is Regulation V. So, Fair Credit Reporting Act. So, what do we think of when we think of something being reported? We want it to be reporting correctly, right? We want it to be reporting accurately. So, if something on our credit is not right, what do we have the right to?
Disputed.
Very good, right? So, sometimes credit repair companies, credit consulting companies, come out and they have the opportunity to dispute your credit. There's some great ones out there and there's some shysters, just like any industry. So you as a consumer have the right to dispute things on your credit in order to verify the accuracy of it being reported, right? Let's say they're reporting that you're late and you're like, I've never been late, or that it's in collections and you paid them and so on and so forth. You have that with the 3 credit bureaus. Who here remembers the 3 credit bureaus?
TransUnion, Equifax, and Experian.
Very good, right? And then we have FEMA, Federal Emergency Management Agency. All right. So this agency started coming around a lot, especially with us here in Jersey, after we got hit with so many floods, right? I've born and raised in Jersey, from North Jersey to my office being in Middlesex to now living in Ocean County. I've never seen rain like we've been getting. I mean, you want to talk about global warming and all this stuff, but I never used to remember things flooding like how it's flooding, aside from like Hurricane Sandy and stuff. But I think it was like 2 years ago, around like September, we got hit with forgot what it was called, what the hurricane was called or whatever. But it was like it killed like Plainfield, Newark, and a lot of kind of like urban areas as well, where the sewer systems were already kind of the reason why I talk about this is FEMA is responsible to drawing out flood maps, right? So I don't know what their Like if they can just change the flood maps whenever they want to. I'm not the licensed professional on the insurance side to know, but I confidently do know that they have redrawn a lot of the flood maps after some of these water conditions, right? Like by my house down the shore, a lot of houses were not too far away from the water. A lot of our houses require flood insurance, right? Because it's just very common for the shore to over whatever water to come out and taking it from that, right? There's also restrictions where they have to increase the height of their homes and stuff like that. But FEMA is a federal agency management association. There's actually a cool thing about it too. And I love staying on top of the news, but when we were getting an FHA loan, you were forced to get specific type of insurance through the NIP, which was usually probably 2 to 3 times more expensive for flood insurance than if you went through a private company, right? Because FHA is a basically federally insured loan. You had no choice. You had to go through that, right? They just made the rule literally 2 weeks ago or 3 weeks ago that you can now have the opportunity to get private insurance for flood insurance, which I think is now going to allow a lot of consumers the opportunity to be able to qualify. Because I'll tell you, I mean, some of these policies were like $3,500, $4,000 a year for flood insurance, on top of hazard insurance, and on top of likely if you had an FHA loan, mortgage insurance, right? So if you were a consumer who was comfortable paying $3,500, and then you got hit with another $300-$400 for flood insurance a month, you're like, either you couldn't afford it from a qualification perspective, or you're like, dude, that's out of my budget. So hopefully that little change will allow some consumers the opportunity, to still get whatever they want. So there's that. FHA, I could talk for hours, right? But we all know Federal Housing Administration, not first-time homebuyer loan, right? So many people come to me and say, "Oh, I'll take that. I'll take that number one, right? Like you're at I'll order a Big Mac. I'll take that first-time homebuyer loan." And I'm like, well, which one? Do you want a conventional loan? Do you want to put 3% down, home ready? Do you want 5%? Do you want that FHA? I'm like, well, allow me to clarify for you. FHA is generally taken advantage of by first-time home buyers because it allows. I want you guys to write this down. A couple things for FHAs that I want us to remember. It allows you to have a credit score as low as 580. It allows you to borrow, hold on, 28, 36, 31, 43, up to 43% of your debt to income. The reason why I halted there is our standards right now, mortgage, like current industry, like January 12th, 2023, it's actually higher. We can actually borrow up to, I'm not even gonna say the number X, but it's a lot higher than 43%. I'm not gonna say what it is so you guys don't get confused. But right, the ratios is 31-43 for FHA, right? As opposed to conventional is what? Who here remembers? What's the front end ratio and the back end ratio?
Sure.
It's
It's like
less.
28 or
Yep, 28's the front. And how about the back?
31? I don't know.
28, it's 28-36. Okay. That is those numbers. It's not going to come blatantly like that, but I can probably tell you guys that you may likely get a question. Don't freeze when it comes to math, but we'll take it from there. Then we have Freddie Mac, right? Again, remember the acronyms as I had mentioned to you guys, and what you should know. Freddie Mac is another secondary agency, right? We have Fannie, Freddie, and Ginnie. Then we already covered FNMA, Fannie Mae, the FTC, Federal Trade Commission, right? We want to make sure we understand and know what the FTC does. What do they govern? What are the fines that they can implement? A lot of the do not call lists generally falls under the provisions of the FTC. GFE, which is a good faith estimate. A lot of the times, it probably won't be used nowadays in an industry term because it's been replaced by the loan estimate. But in case you guys ever see this come up on the exam, GFE, good faith estimate, is basically the exact same thing as loan estimate. just what it was used to refer to. Then we have the GLBA, the Graham-Leach-Bliley Act. The Graham-Leach-Bliley Act was 3 senators that got together, put this act together, and they came up with the what I call the rules of SPF. Who here wants to take a stab? What did the GLB kind of help?
Privacy.
Okay. What else? I hear the page is turning. So SPF, before we think, what do we think of? I'm a Jersey Shore guy. What do we think of when we talk about SPF?
Sun protection, beach.
Yep. I guess you guys get that connotation, right? From
To
Jersey Shore.
protect the client, right?
What's that?
To protect the client.
Correct. So I want you guys to write SPF on a vertical, whatever you want to call it, on a straight line. So S stands for safeguards. So safeguards the consumer. P stands for pre-texting, right? Where you're not allowed to blow someone up. And then the F stands for financial privacy. So someone mentioned privacy, which is true about financial privacy. Okay, so safeguards, pre-texting, financial privacy. Right? GNMA, okay, which is the Government National Mortgage Association, also known as Ginnie Mae. They're usually the one that has the mortgages pool, right? They pool the mortgages. GSC, government sponsored entity, which we kind of touched based on, right? GSC, government sponsored entity, which is generally Fannie, Freddie, and Ginnie. That's good. HELOC, home equity line of credit. We all know what the HELOC, home equity line of credit. Again, it's made a recent big buzz within the news. It's kind of like a line of credit, right? Where it doesn't replace the initial mortgage, right? Which is a big one. So a lot of my clients hit me up nowadays who had closed in like 2017, 18, 19, and they're sitting on a lot of equity, right? When they're sitting on a lot of equity, what that basically does is it simultaneously, you can take the money out, right? Especially when the market appreciated for the last 2 years. So people can take out a HELOC as opposed to doing a whole cash out refi, and it doesn't replace the first mortgage. The first mortgage remains the same with the rate, their term. They take out a small HELOC. It's kind of like an Amex, I always say, that allows you the opportunity to do that, right? Housing expense ratio, right? HER, which is the front end ratio, like I touched base with you guys. So that's that 28 for conventional. That's that 31 for FHA, okay? You guys all remember how to calculate that. Your housing expense ratio is very simple. It's essentially just your mortgage payment, which is your PITI, principal, interest, taxes, and insurance, right? You divide that by your gross monthly income. If you're a W-2 employee, or if you're a self-employed employee, you take your monthly payment and you divide it by your net income, right? Housing and Economic Recovery Act, HERA, again, SAFE Act was a part of that. That's why we're here. Home Mortgage Disclosure Act, I'm going to go through these. Home Mortgage Disclosure Act, HMDA. So HMDA is important. So HMDA is something that lenders, when we take a 1003, 1003, guys, is a mortgage application, right? When we take a 1003, we have to disclose the client's race, ethnicity, and gender. Okay. And we have to say how we took it. If it was in person, over the phone, or we took our best educated answer, right? So we have to know their race, we have to know their ethnicity, we have to know their gender. Mainly because we want to know specifically if you're, you remember that example I gave between Anna and Simone, where I was giving Simone a better deal, and then I wasn't giving Anna a better deal. So banks are really monitored with that, right? So every single year, believe it's March or May, or it might even be April. I'll get the correct answer for you guys. But banks have to submit a list of their whole loans, and that information is included in there, right? That's why you'll see some, not going to name names, but some big institutions get hit with discriminatory lending, right? And you guys should have gone over with your instructor about steering, redlining, and blockbusting, right? This is how institutions are kept accountable, right? Because of this stuff, okay? Homeowners Protection Act, HPA. So I was talking to you guys briefly on Tuesday about Homeowners Protection Act, specifically for what? What is normally placed on a home to protect the mortgage company?
A lien?
Close.
Mortgage insurance?
Very good. Mortgage insurance, right? So whenever we think of Homeowners Protection Act, I want you guys to think of mortgage insurance, right?
Mhm.
Okay, makes sense. So great when we break it down, right? And that's where I really want you guys to, if you try to sit here and memorize these terms, even me doing this for a while, I'm sometimes like, oh shit, I don't remember what the hell is HPA? You know, but then I'm like, well, what does it stand for? Homeowners Protection Act. Well, what protects homeowners essentially through mortgage lenders? Mortgage insurance. Oh, well, I know that. 80% LTV, 78%, 20% equity, 22%, right? Remember that, right? 80% loan to value, you can request it, or if it starts from the beginning, 20% equity, just like 78% loan to value, 22%. That's good. Actually, I skipped one in between. Home Ownership and Equity Protection Act. So when we talk about these, we're thinking of, you guys went over higher price loans and high cost loans, right? Did you guys go over that with your instructor? Higher price, 1.5, 2.5, 3.5 higher. 6.5, 7.5, right? In terms of interest rates. The HUD, which is Department of Housing and Urban Development, that is all going to fall under the parameters of specifically, right? They monitor FHA, right? FHA is a part of HUD, Housing and Urban Development, right? LIBOR, London Interstate Banking Offer Rate, that's going to come into play specifically for a ARM mortgage, right? What's the initial offer rate that's coming about? LP, Loan Prospector, via Freddie Mac. So you guys remember when we were going over DU, was the automated underwriting system for Fannie. LP is the automated underwriting system for Freddie Mac. Okay. LTV, loan to value. We kind of touched base on that briefly. Mortgage Disclosure Improvement Act, self-explanatory. Make sure we get the disclosures out within time. Mortgage insurance premium, MIP. This is for FHA, right? Because mortgage insurance for the entire length of the loan, if you put less than 10% down. So remember, guys, that mortgage insurance premium. MTA, 12-month treasury average. You guys probably won't need to know this, but again, understanding what are treasuries and the importance of them in terms of rates. NMLS&R, the Nationwide Mortgage Licensing System, which is the NMLS, and the registry. So when you guys, fingers crossed, take this, put in your application, register, pass, you put in your request to become a licensed mortgage loan originator. When you put in that request to become a licensed mortgage loan, your information is kept in this registry. So God forbid you guys have any complaints against you or grievances, it's public knowledge. So I'll put in there. If you guys want to find out when a person started in the industry, you search the NMLS&R. If you want to find out who they're currently working for, you search the NMLS&R. PITI, we kind of touched base on that. It's your mortgage payment. Principal, interest, taxes, and insurance, right? PMI, private mortgage insurance, right? Through a conventional loan. POC, paid outside of closing. So usually you'll have your appraisal or your 12-month escrow of insurance is POC, which means paid outside of closing, right? What is the only fee that you are allowed to charge a client during the mortgage process?
App fee?
No. I should say you're allowed to charge a client before closing. Let me revise that.
Appraisal fee?
Yes, but that is to a third-party appraiser. I mean, from us as a mortgage company. What's the only fee that we are allowed to collect from a consumer prior to closing?
Oh, no.
You guys got this. Remember, it's don't overcomplicate it. So when we're when we're thinking about buying a car,
Credit?
bingo.
Oh, okay.
Go to a car dealership. What do? They run your credit, right? Just like when a consumer comes to us, what do we have to do? We have to run their credit. Okay. That is the only fee you are allowed to charge in advance. Doesn't necessarily mean that you're going to, but that's the only fee that you are allowed to charge in advance to a client, the credit report fee. I have heard, I don't like saying this, but I have heard that question has been pretty common for it coming on the exam. Okay. I have no idea if it does or it doesn't, but just for sake of understanding, guys, credit report fee is something that can be part of it. And then we have where did we go? Where did we stop? That's a RESPA. I've mentioned this a few times, right? Real Estate Settlement Procedures Act, REXPA, Regulation X. So real estate settlement procedures. When I think of procedures, we're going to think of escrows. We're going to think of kickbacks, right? You guys went over kickbacks. We're going to think of a lot of different settlements specifically within time frames, right? So you guys think of that, break it down. RESPA, Real Estate Settlement Procedures Act, REXPA, or RESPA, okay? SAFE Act, why we're here. Secure and Fair Enforcement Mortgage Lending Licensing Act, why we're here, where we're taking the class, came about predominantly as the market crashed back in 08-09, forcing every single professional within mortgages who was either already in the industry or about to get in the industry to become licensed, right? So we're therefore, it also stayed enforced regulations, I should say, in regards to compensation. So we're all here because we like to help people, right? And spread knowledge. But we're also here because we like to make money, right? Compensation. So this put a lot of different rules and provisions specifically in terms of compensation, right? So how do you get paid? You can get paid a flat fee. You can get paid based off of what's called the basis points, right? You guys remember basis points, which is 1/100th. So if you're at a, say, 100% basis points comp, that means you get paid 1% of the loan amount, right? So if you do a $400,000 loan, right? Not sale price, it kind of sucks, but based off of the loan, the money that we're lending. So you do a $400,000 loan amount, your commission, your payment is $4,000, right? Makes sense. So there's that. There's also some tiers that companies do pay to. Like if you do $1 million in business, you'll get paid 100 basis points. If you do $2 million in business a month, you'll get paid 150 basis points, so on and so forth. But again, in no case would it be predatory where, well, if you sell them FHA, you get paid 100, and if you sell them conventional, you get paid 200. Or if you give them 2%, you get paid X, and you give them, 3%, you get paid Y. Right? No way, Jose. So service release premium. So a lot of mortgages that conform, right, through Fannie Mae and Freddie Mac guidelines, there's a reason why banks follow specific rules for Fannie Mae and Freddie Mac. So loans, does anybody here own a home? Anybody here have a home? Yes, perfect. Anna, if you don't mind me asking, when did you buy your first home?
2017.
2017. Are you still paying the same lender?
No.
Your loan probably got sold either right away or within the first 3 months or something.
Yeah,
like
it was fast. Yeah, and then it happened a few times after that.
Did anything change for you aside from maybe your taxes and insurance going up?
Yeah, but no,
Uh,
nothing.
Your principal and interest, your rate, let's say you were 2 months into it, you still owe 358 months if it was a 30-year mortgage, right? Nothing changed, right? You
Nothing.
just didn't pay bank A, you now pay bank B, and then bank B sold it. So when a bank sells a loan, that is a service release premium. Right? Excuse me 1 second. Frankie, what's up, brother? Good, man. Good. Just in the middle of teaching a class. Yeah. Let me have the buyer's agent send the info to you guys right now. Did they accept the contract? All right, perfect. All right, good stuff. Thanks, brother. All right, guys. Okay, so yeah, and no changes to you. Now, when a bank sold it, they generally sometimes sell it with a service release premium. No change to you. Just bank B will buy it and pay whatever it is, $5, $5,000, whatever it is. Okay. Truth in Lending Act, which is the TILA, right? TILA is the TILA the Godzilla, as I always remember it. So Regulation Z. It's really all about being truthful. So when we think of being truthful, what do we think of? We think of advertising, right? When we go online, or you talk to a company, or whatever the case may be, being truthful, right? Total obligations ratio. So total obligations ratio is a back end ratio, which we were going over 28 and 31, right? For FHA and conventional. Now it's the back end, right? Which is 36 conventional, right? And 43 FHA. Okay. Now, when you guys are doing your math, trying to calculate it, you remember that pity I was telling you guys about? Your principal, interest, tax, and insurance. So you add that on top of all revolving minimum payment credit card debt, car notes, installment notes, right? So One Main Financial, any small institutions. Also, child support, alimony of your monthly payments, IRS tax payments. I mean, I can go on, right? Loans that you've taken out, stuff like that. So you add that, that's your total debt, right? And then you divide that by the income, whether it's gross monthly income or net income for 1099. So make sense? That number can exceed, again, 36% conventional, 43% FHA. TRID. So TRID is the TILA RESPA integrated disclosure. This always makes me look, I always laugh at this because I always get a phone call and, a realtor's like, hey, really need your help. Client needs a hand, stuff like that. How quick can you close the loan? I'm like, dude, I got you. I can close it in 7 days. It's like 7 days. I've worked with people who can close quicker. I'm like, no, you haven't. Yeah, I do. You haven't, because it's federally regulated that you cannot close a loan in faster than 7 days. So the 373 rule. So I want you guys to write that down. 373. So when we get an application, actually, before I dive into this point, what constitutes a full mortgage application when you guys are doing the mortgage process? Who here remembers? What are the components that you need to know?
Like their taxes and social security number, name.
Close.
Or
Did you guys go over the acronym? I usually like to tell our instructor teachers called aliens, or no?
Yeah, we did.
You did. Okay, cool. So write this down. So same thing, vertical, like I had you guys do the other one. So aliens, like Martians, Mars, aliens with an S, right? And I'll break down each one of you guys so you guys can remember this. So the A stands for address, the address of the property. The L stands for loan amount. Who here wants to guess what the I stands for?
Income?
Very good. Income, right? We need to know what the client makes. And then we have the the E. What do you guys think?
Employment?
Close. Kinda. That would be a good one, but
Mhm.
no, it's not employment. So estimate of
Está
value.
bien, gracias.
Estimate of value. Okay, so estimate of value. So ALIE. How about N? What do you guys think the N stands for?
Name of the borrower,
Very good. And then the S.
social security.
Cool. Okay. Everybody got that? And that's a full app, right? I know what I'm buying, the address. I know what I'm buying it for, based on financing, L. I know what it's worth. I know how much I make. I know who's buying it. And I know their social, so I can identify them. Aliens. Okay, so going back to that, so 373 rule. So once you have the alien, you have the contract. By law, you have 3 days to get what out to the borrower?
Disclosures,
Close. What's the disclosures called?
Loan estimate?
Very good. LE, right? Loan estimate. Used to be called, right? GFE. So you have 3 days. What do you guys think the 7 stands for? I kind of gave us an elaborate story, but
Days to close.
it's the close, right? So do it. So do the math. 3 days for the LE, 1 day in between, 3 days after that. 3 plus 3 plus 1 is 7, right? So 7 days to the close. And then the last 3 stands for what?
The CD, right?
Very good. CD. If the CD goes out, CD gets signed, then you're eligible to close within 3 days, right? USDA, US Department of Agriculture, right? A few areas in Jersey. I'm going to be completely honest with you. I think I've done maybe 2 in my entire career, USDA loans. Probably pretty common, a little bit more. Let's say the Midwest. Jersey, there are a few. I did one in like Forked River. But USDA loan, what's a benefit of a USDA? I know a lot of people like that.
Is it because you wouldn't have to, right.
So when a client's buying a house, right? Aside from credit and all that stuff, what's usually the biggest client's hurdle?
Is it because you don't have to put that much down?
You don't have to put nothing down. 0% down. So you can actually put 0% down on a home and purchase it. Now you got to reach obviously certain debt to income ratios and so on and so forth. You give it 0% down. Now the catch, quote unquote, or the requirement is you cannot make more than a certain percentage of the area median income, right? So you can't make, whatever the number is, $1 million and get a USDA, right? What is that certain percentage? Who here wants to remember? What's the percentage that you can't make more of from the area median income for a USDA loan?
25%?
No.
that's not it.
43%?
So it's, think about it, right? So when you're at 100% of the area median income, that means you make it. So it would be more than 100%. So what do you guys think it is?
150?
Close. 115. So you cannot exceed 115% of the area median income. Okay. So if the area median income of a house is, no, 100 grand, you can't make more than 115%. Let's do an example. I'll show you guys. So let me go. Where do I have my ops? Here you go. AMI. There's no shortage of bookmarks in this. So let's go. Let's do it based off of our office, right? Here you go. So area median income in the Woodbridge area is 83,600. Everybody can see that? Where's my calculator? I got so many screens. So we're gonna go 83,600 times 115%. Client cannot make more than $96,140 if he wants to get a USDA. He makes 100. Can't. Alrighty. This industry, guys, I love when you understand it, right? When you really break these things down and understand, you're like, oh, it's easy. And then you become that much more successful as a professional. VA loan, VA is a big one.
Question.
Yeah, yes.
When you do this type of loan, the property has to have 25 acres or more?
I don't think so.
No?
I'm gonna be honest with you. I'll get back to you on that.
Okay.
I am, by the way, the first professional to get back to somebody on something. I never like to say something. I don't think there's specific what the hell do you call it? There's specific
Size?
bridge restrictions. I know that the property itself must follow.
Okay.
So let me see. To be honest, I barely do them. So you can go USDA property eligibility, pull it up, and then you can search it and go something guaranteed that you could search the property and find out if the property this is a commercial building, so I don't know if it would work, but see, boom, property not eligible. You see that where it says property is not located in an eligible area. I would put some properties that I have done them, but this is being recorded, so I don't want someone's address out there. But there will be there are certain parameters to the eligibilities. To be honest, I'm the first one to tell you, I really don't know what specifically it is in regards to. I usually just pull that website out, check if the property is eligible, advise my agents really to check when a client is sending them property to check if the property is eligible first, because that's the route that we have to go. Right. So,
Okay.
and then you have a VOE. So VOE is verification of employment. Verification of employment, we always do that, right? When we're checking a client's income. Guys, I'll tell you, I've been doing this for a little while now, and there's never a shortage of me trying to be nice here, but entrusting humanity. I've had people give fake tax returns, fake pay stubs. I've had consumers do all different types of stuff. Consumers give a tax returns, but then go and amend it and file something else. We verify everything. So everything gets verified. It was also really tricky around COVID. That was a disaster. When a lot of people were being let go. Oh my God. I was like, dude, please keep your job. We're closing in 2 weeks. And they'd be like, no, I got let go. And you're like, kill the deal. Yeah, it was not fun. I think it was like around that funky March to really like May, June, right? When everybody was kind of being more or less terminated or laid off, or what was the nicer way to say it? I forgot. Whatever. Yeah, people were, or furlough. There you go. People were being furloughed. They're like, oh, I didn't lose my job, but I'm just not working. Okay, so how are you going to pay the mortgage? So there's a lot of parameters. A lot of industry guidelines shifted too. Really within the last 2 years, there's a lot of changes because we always needed like 2 years of consistent history. Rules started changing where if you got an FHA loan, as long as you were back to work, if you had more than a gap of 6 months, as long as you were back to work for 6 months, for that specific job, you were good. And then about July or August of last year, they changed it from those verbiage saying specific job to line of work. So you could have worked a different job as long as you were, say, I don't know, a teller at one bank and a teller at another, you were good. Before it was you had to be at the same bank. So not to confuse you guys, but verification of employment, super important. We do it to verify the client. There's a lot of companies sometimes do it automated through like a work number, or some companies have HR there to fill out the VOEs and stuff. Okay. And then just like when we verify clients' employments, if you have a current mortgage, we also do a VOM where we verify your payments, right? We verify how you paid your mortgage. Did you pay on time? Did you have any late payments within the last 12 months? That's been really tricky too with COVID. Clients were in forbearance. The rule changed, or if you were in forbearance, you didn't need to prove 12-month payment history on time after that. You just needed to show that you're out of forbearance. You're either caught up entirely or you're out of forbearance, push this to the back, or whatever the case may be, and then you made 3 consistent payments, right? But again, purposes of this, verification of mortgage allows us the opportunity to verify how you paid your mortgage history. You paid it on time. So. All right. And that's the acronyms. Any questions?